Hello, and welcome to the Fidelity Upside. I'm Emily Ananwevo. According to research, working with a financial advisor is one of the best things you could do as an investor. An advisor helps you figure out your goal and a plan to get there, teaches you how to save with discipline, and an advisor helps you invest in the markets. The Upside is an interactive webcast designed to complement this important work advisors do on your behalf. Our mission is to connect you to Fidelity's best investing minds, share insights about the markets you won't get anywhere else, and inform and inspire you to work closely with your financial advisor and be a better investor. Joining our very first show today is global dividend investor Ramona Persaud. Ramona manages many investments on your behalf, and we welcome her from Boston. Ramona, so great to see you.
Nice to see you too, Emily.
Happy to have you here as always. I'm excited to jump into this conversation with you. And I just want to remind our viewers, if they like to be part of the conversation, please do so. We encourage that. Just click on the Q&A icon there you see at the bottom of your screen, submit your questions, and we'll get to as many of them during the show as we can. Ramona, in your day job, you study and follow the markets, of course, work with analysts all over the world, and carefully pick stocks to protect and grow people's money. But this is not what you set out to do early on in your life. I know that. What led you to a career as a portfolio manager? Because I know there's a neat little story behind that.
I'll try to be quick. Yes, I always loved math and science as a kid, and my dad was an engineer, so I sort of didn't have a choice but to go study engineering. And my mom is one of these people that just runs big organizations, so they sort of pushed me in that direction. And I loved engineering school. I loved essentially learning how things work. And the research that goes into figuring out how things work and potentially how to make things work better. But then I discovered financial markets living and growing up in New York City. And I realized that it's not that different in financial markets, and certainly in investing. Figuring out a company and figuring out a stock is very similar. You're figuring out how a company works, how to take it apart and put it back together in a way that would make it work better. And that is a core part of what investing is. So they're very related, actually.
So interesting. I mean, your background, the engineering background is so fascinating. I know you've lived and worked all over the world. And we know that every good portfolio manager has a certain philosophy, a certain way of investing. Mm-hmm. For example, Warren Buffett, many people call him a value investor. What is your philosophy as a global dividend investor? What does that mean exactly? And how do you incorporate the philosophy every day for our viewers and those invested in your funds?
Of course. So I should start with what we're trying to accomplish, and then I'll tell you what I believe and how I implement it in order to accomplish it. So we are trying to accomplish three things. We're trying to get investment return for our clients, which is what everyone's trying to do. But in addition, I want to do two more things. I want to get downside protection. That means when the market goes down, I want to be able to not go down as much and potentially not even go down at all, depending on the type of market that you get. So downside protection, number two. And then number three, I want to be able to provide a reasonable level of income. So if you combine those three things together, investment return, downside protection, and income, essentially I'm looking for sort of a risk-adjusted total return with not a whole lot of risk embedded in it. And so that is what I'm after, and how I get there is based on what I believe. I believe that if you are careful about what you pay, you will be able to get a really good return. So I believe that a value orientation to how you invest will get you that first goal of investment return. And the data and the analysis sort of prove that out over time. Secondly, I believe that quality companies really help to mitigate the risk in your portfolio and in fact drive that second goal of downside protection. So I like to buy really good companies. And then the third thing I believe is if you're buying a quality company, typically you're getting a lot of cash flow off of that company. So I want the companies to do smart things with the cash. So I'm also looking for companies that are putting that cash to good use, one way of which is in healthy dividends. So that's my sort of three-part belief system. And then the way I implement that is in using Fidelity's extensive research resources. So we've got lots of analysts, 120 analysts sitting all over the world, doing investment research on companies to bring us the best ideas for the funds ultimately. So that's the investment process.
Fantastic. Thank you so much. Great overview there. You talked about downside protection. And so let's talk about the markets, right? The headlines in the media, every day can be a bit confusing and scary for investors. Markets going up and down, obviously buzz around the US election and second waves of COVID-19. In your view, what are the insights, investors should be aware of, and what's happening right now? And where, if you can paint a picture, where are we headed in the future?
So that was a lot of pieces. I'll try to hit all of them. Maybe I'll start with where we were, kind of where we are, where we're headed, and from that we'll get some of the insights that you mentioned. So where were we? We came into the year and we'd had really good run in stocks. And so valuations were pretty extended. So I came into the year sort of cautious, and I was already fairly cautiously positioned. And then we get this random left field pandemic, which started out not as a pandemic, just started out as something swirling around Asia. But it turned into a global health pandemic. So where we were was an extremely scary place. It was scary, certainly from a personal health perspective, for every single person on the planet. And from a market perspective, what that meant was incredible uncertainty and therefore volatility. So sort of bifurcating your life in two ways. Oh my gosh, there's this health thing happening. I really need to, be careful, but also huge uncertainty in the market. What an opportunity. I equate uncertainty to opportunity. So that's where we were, and all of the data, and I could speak very technically, valuation spreads, everything said that this was a huge opportunity. Then we ended up very quickly into the market rebounding and less opportunity, but still a reasonably high level of uncertainty. So that's kind of where we went to and where we are today. There's still uncertainty. It's not quite as strong as it was in March, but it's still pretty high. And so in terms of insights, what does that mean? Again, I equate uncertainty to opportunity. So the way that I think of this job is that I am responsible for absorbing that uncertainty and the associated volatility that comes with it. My job is to take that uncertainty and volatility on your behalf, and really try to figure out what to do with it in order to help you secure financial wellness over the long term. So if I believe that uncertainty leads to, for instance, stocks selling off in an indiscriminate fashion, meaning the great companies and the terrible companies both get sold off in the same way, that means that I can buy great companies at prices that have forgotten essentially that they're great. So that's what uncertainty is, but it really takes the sort of stomach that is interested in heading into storms when everybody else is heading out, as long as you have the analytical backing to drive the conviction that certain storms are worth heading into and others are not. So that's kind of the insight, if you will, that was certainly present in March during all that uncertainty and continues to be present now as we get uncertainty around all sorts of different things. Of course, the pandemic, but also elections and trade and interest rates and whatever else the market is going to throw at us.
Yeah. We have a few questions rolling in, and this is sort of related to obviously what we're seeing in the headlines, the US election, so much buzz around there. It's a month away, less than a month away, I should say. So a viewer has a question here. What are your thoughts on the potential impact of the US election on the market?
So it's already having an impact, which is the market's trying to figure out what's going to happen. Certainly with every passing data point that we get. And it's instructive to remember that at this point in 2016, there were some fairly strong predictions that did not come through. So we have to remember that the predictive mechanism about elections currently is not that robust. So we could continue to get a whole lot of uncertainty going into it and certainly coming out of it. The market flavor the last couple of days, certainly as the president of the US has gotten ill with the virus, is, whoa, what if you get a Democratic sweep? What does that mean? And so the market is interpreting that as lots of government spending and frankly, central bank monetization or central bank buying of that government spending. So the market is thinking, all of a sudden the market, which was very unhappy a couple of weeks ago, is now super happy thinking, oh, that's going to lead to all sorts of spending and therefore lots of companies that are economically cyclical, economically sensitive, doing really well. So the market is really into value stocks right now. And who knows what will come next week. So if I step back from all of that, most of it is noise. I truly believe that when you've got so many exogenous variables, again, you've got pandemic, election, trade, interest rates, whatever else, right? A lot of it is exogenous. A lot of it we just can't predict, and we shouldn't even attempt to predict because we're not going to be right. What I actually believe instead is you'll get all of these variables, and what that will do is just hike up the uncertainty factor in the market. When you get heightened uncertainty, the stable, predictable, reliable companies, reliability can sometimes become cheap. And I'm really into reliability. So certainly personally, but also as an investor. So when I can buy reliability, stability, predictability cheap in these moments of crazy uncertainty, I go for it. So I basically, the work that I do is constantly trying to value reliability, meaning quality companies that don't change that much. So people will still go to the supermarket. People will still buy, consumer staples goods. They'll still buy paper products, and they'll still buy whatever it is they buy to drink. And when companies like that get really cheap relative to where they should be valued, I step in. So that's the way I deal with exogenous variables and deal with just heightened uncertainty in the market. Wait, just be super patient and wait for your price.
Right, absolutely. And the uncertainty and the discomfort you talk about, we'll chat about that a little bit later on. A few more questions coming in about market volatility. So one viewer is asking, with market volatility increasing, job growth slowing down, corporate earnings declining, what are the odds of a 2021 recession?
The market is a really aggressive discounting mechanism. So the market is trying to see through all of these things, that sort of like laundry list of things that you mentioned. And if you think about where we've been recently, which is in this depressed state, right? Like you got jobs, a whole bunch of jobs going away, a whole bunch of demand for things, demand, economic activity just being reduced. What the market is actually trying to discount right now is that we are in what we call early cycle. We're in the beginning of a recovery, because to the extent the pandemic gets solved, which I do believe it is continuing to be, I don't believe, it's sort of a fact, it's not a belief, that it is being solved by science more slowly than all of us would like, but we keep making forward progress, then that means that the demand that we lost comes back. So the reason the market has just seen through all of this badness is because the market can see that we're going to get to the other side of it and demand will come back. The question that's being asked is whether as soon as that demand comes back, we get some kind of variable that launches us into recession again. It's hard to know. I think it's very data dependent, but in my view, I think we're much more on the early part of a recovery side of things. Certainly from an economic perspective, valuations might be a different story. And so that makes me more constructive than less.
Understood. You talked about being in an early stage of the economic cycle, which kind of leads me into my next question. In this part of the economic cycle we're in, what types of investment themes might be appropriate at this moment? And what are you thinking about sort of in the future?
Right. So one of the things I said when you asked me about what I believe, my investment philosophy, the first thing I said is I'm looking for investment return. And I have a deep belief that what you pay very much drives what you get. So the return you get is very much a function of what you pay. So I'm constantly focused on valuation. And whenever I talk to clients, it's all about valuation. So if you look at valuations today, that often will tell me where is there opportunity in the market, and where valuations are really interesting, where the market is priced in a way that's not reflective of ultimate value, is in economically sensitive stocks. So as much as the market is trying to look through to the other side and see demand coming back, it's still a little bit hesitant, right? Because we still have a lot of uncertainty about the rate at which the pandemic will be solved and therefore demand will be solved. Mm-hmm. So in highly cyclical pockets of the market, so consumer cyclicals, or energy certainly, or financials, or materials and industrials, these are all areas that I have been increasingly constructive in, and I've been sort of lessening my focus in what I referred to before, the reliability parts of the market. So in general, I'm looking for reliability that's cheap. But when it's not cheap, you'll find me going more towards the economically cyclical stuff, which is what I've been doing. And I've essentially been aligning my increased exposure to economic cyclicality with the march that science is on, sciences, if you will, science's march towards solving the pandemic, because those two to me are very analogous. Economic recovery is very, very much aligned with scientific progress in terms of the problem. The problem is a science problem, which is actually of great comfort to me because it means that there's a defined solution. We just need to do the work to get there. So that means that I can, other than previous crises, I know what my playbook is. I basically have to position for an economic recovery because I know that the problem will be solved. I just have to be careful about how I do that. Like I can't do it all at once and I can't do it too slowly. So I'm doing it sort of aligned with the progress that we're seeing.
Perfect. Another question here, Ramona. How do you view dividend investing in this low interest rate environment?
Good question. So dividends have sort of a scarcity value, if you will, because rates are so low, because they are an alternative source of income to fixed income. And so when fixed income goes away, people start looking for it in other places. And certainly in the last 10 years, as rates coming out of the global financial crisis, rates have been low, we have gotten a re-rating, if you will, of income producing stocks. People have gone looking for their income in stocks. So that is interesting to me as somebody who one of my mandates is to produce income in these funds. But when one of my mandates is also valuation, I have to truly sort of like do the trade-off between the income that I'm seeking and what I'm paying for it. So that has been tough in spots. When the market has a really strong belief that rates will never go up again, dividend-oriented stocks, income-oriented stocks become wildly expensive, and I will sell them all. Not all, but I'll just really sell the most expensive, because I can't sell all because I'm trying to produce some income, but I'll basically reduce my exposure to yield because they're too expensive. And my fundamental belief is what you get what you pay, right? The return is very much associated, you can prove this quantitatively, return is very much associated with valuation. When they get cheap again, which is typically when the market starts to believe that rates will go up, and we're seeing that currently. So there's a backup in rates, certainly in the US, and the market's sort of freaking out, and you will get income sensitive, income-oriented names that are rate sensitive. You'll get those selling off. I will then step back into that exposure. So I use valuation as a guide for how much yield exposure to have, because in my mind, you can get all the yield you want. But if the return on those stocks gets clobbered because you bought those stocks too expensively, then what's the point of your 3% yield if the stock's down 30%? And we saw that in the first half of 2016. All of these consumer staples, they got bid up to like 25, 30 times, and then they crashed in the second half. And so you lost a lot of return. And if my goal is total return with risk sensitivity, then I got to be really careful what I pay for yield stocks. Does that make sense?
Yeah, no, it does make sense. And, you know, just your mindset and that certain way of investing, I find it, you know, fascinating and really unique. And there's a lot going on. So how do you sort of balance it all, Ramona, and kind of focus on, you know, certain themes you're interested in these days? And how do you, you know, balance that out with following certain investment trends?
Do you mean all the different things I'm trying to keep track of and making sure that,
exactly.
So I think you're asking, how do I kind of stay big picture, but still stay on top of the details?
Exactly.
One of the things you actually learn in engineering concept in a way is, and it's sort of a life concept, is how to find the signal in the noise. And it's a technical construct, but it exists everywhere. And so I view my job, frankly, as trying to decipher signal in noise. And what happens when you get so many exogenous variables, another word for uncertainty is noise. You get a ton of noise. And so I'm constantly trying to sift through the noise in order to find the signal. And I'm not good at it. Yeah, I mean, I'm reasonable at it, but I will be even better at it in 10 years and 20 years. And I was not as good at it 10 years ago. So I believe the constant practice in differentiating signal from noise is how I answer your question. That's how I stay both on top of the details, but making sure I understand which details are important. So I read everything. We have 120 analysts sitting all over the world, and that's a lot of research, a lot. And I read it all. That doesn't mean that I act on it all. And I'm frankly reading it to be able to differentiate signal from noise. A lot of it is noise, but it sort of definitionally has to be that way. And there's very few times when I read something and it causes me to act because there's that much signal. But if I were not going through the noise, I actually would not be able to parse out the signal. So it's a very time-consuming job, but once you find the signal, it's incredibly exciting. So you're constantly motivated to go through all this stuff in order to find it. You're like constantly on a hunt for signal. And the signal is literally when a stock gets cheap enough, or when the market is seeing things one way, but you're seeing it another way, and you have all this backup, all this analytical work from your analysts saying, leading you to the conclusion that you need to take the other side of the market's position. That's when it gets really exciting.
Constantly on the hunt and constantly reading and researching, it seems like. We have another question here, Ramona. You being a global manager, where are you seeing opportunities around the world? One viewer asks.
So I use valuation to often figure that out. I also obviously use the inputs we're getting from analysts and the companies that we're meeting with. The valuation tends to be my starting place. And what I look for is differences in valuation, because what life and the market is a relative game. So you're constantly trying to figure out like what's expensive and what's cheap. And for the longest while, the US has looked, if you look at the US relative to the rest of the world, and certainly say the US versus emerging markets, the US has looked really expensive. And so the knee-jerk reaction to that would be like, okay, sell the US and buy a bunch of, say, emerging market, but you have to do the fundamental work to figure out if it's justified and if you should actually stick with your US position. And we're in a tricky place right now because sticking with the US position has been the correct call for a very long time. But now we're at a place where if we do get a ton of what's called reflation, a ton of spending that just reflates the global economy, that's actually much better for emerging markets and for international stocks. So I'm in this process of trying to figure out if that's more where I want to push. And at the margin in my economically cyclical stuff, valuation has been telling me to push that way. So I found some good industrials in Europe. So like Siemens is a really, at times a really good stock, not often a very good sort of high quality company. By virtue of being an industrial, it's typically not going to be high quality, and when you just look at the numbers, it doesn't shake out as quality, but it will sometimes get cheap enough that you have to go there. Transports across the world. There's an Asian logistics company that is very sensitive to trade in Asia, which obviously has been under attack, certainly by the trade war, but also by the economic situation. And so that's gotten sold off a lot. So I'm there. So various economically sensitive areas outside of the US are looking more interesting to me today.
Like I mentioned off the top of the show, advisors play an important role in ensuring we stay disciplined and stick to a financial plan over the long term. Why is this important in terms of sticking to a plan and thinking long term and being disciplined? Why is that important?
Sure. Well, just speaking about advisors, I think it is important in a context where there's so much uncertainty. And if you can make the basic assumption that humans are both rational and emotional, and when uncertainty goes up, the sort of rationality to emotionality quotient goes kind of flips, and it's natural to be more emotional. That if you have advice that is objective, grounded, and highly experienced, it can help you keep your sort of rationality to emotionality quotient the way it should be, which is more rational than emotional. So I think having external objective advice just helps to keep your, to stay objective when looking at the markets. In terms of being disciplined, both using an advisor is a form of discipline, but as an actual investor, discipline is what helps me to actually, both in life and in investing, hit my ultimate goals. So if my goal is to give you total return, which is price plus dividends, in a risk-sensitive way, meaning to give you those things without taking a ton of risk, the only way I'm going to get there is to be disciplined. If I'm constantly sort of going after the next shiny thing in the market, I'm definitely not going to get as good a total return as if I'm just really sticking to my process. And I'm certainly not going to get that total return with minimized risk. So I have to be really careful that when the market is not going my way, that I'm not swayed by whatever is in fashion at the moment. And having done this long enough with good results, that reinforces the discipline that I've sort of developed over time. Not to mention that just like if you're going to go through engineering school or just, like sort of in your formative life, get to the point where you can be in engineering school, you're going to have a lot of discipline to begin with. So it's always been reinforced. Like I've always had the reinforcing mechanism that being disciplined actually has long-term rewards. But you just, what you need with that is an inherent amount of patience to be able to wait for that reward. And what's really hard is the discomfort, the immense, tremendous discomfort of when you are being disciplined and you are sticking to your process, but the reward is not coming. And that's when you have to navigate this line of discipline and conviction versus flexibility. And it's a really tough, that is actually the hardest balancing act. Is I know I believe in my process. I believe in what my process can do long-term relative to my goals that I have for you, the end investor. But when it's not working for a really, really long time, I have to adjust something without losing my ultimate discipline. That's one of the hardest things about the job.
The discipline and the patience. And we have a few minutes left here, Ramona. And if you can sort of leave our viewers with a final thought here, because I know we've chatted in other occasions about that discomfort that you embrace. How are you going to embrace that going forward as we continue in this pandemic, as we continue into 2021? How are you going to do that and continue to better protect and grow, your investors' portfolios?
Well, it's very much tied to your last question, which is continue to be really disciplined about my 3 goals for you all, but also with the humility to understand that there's always ways in which my process, my very disciplined process can evolve. So continuing to be disciplined, but continuing to grow my perspective to evolve my process. So for instance, really respecting that the market has put a huge value on huge free cash flow generators without much focus on valuation. So I love valuation. I love using it as a guide, but really trying to understand why that hasn't worked for the market, why that strategy hasn't worked for the market for the last decade, and trying to understand where in my process can I evolve my process to still get good results for you without giving up my core beliefs. So I will continue to just walk that line and be really balanced and thoughtful in navigating sort of those two things.
Ramona, I want to thank you so much for joining me on the show today. It really is always great to hear from you. And thank you so much for sharing your insights and thoughts with the audience today. I really appreciate that.
Very welcome. Thank you for having me.
And thank you all for watching and interacting with us here on The Upside. Our content to help all of you doesn't stop here. We will be bringing you The Upside every 2 weeks until the end of the year, and we will bring you more shows in 2021. We also have The Upside on YouTube, where we cover a range of topics from retirement planning to investing best practices during market downturns. And for more Fidelity Portfolio Manager commentary, you can find us on your podcasting platform of choice by just searching Fidelity Canada, as well as visiting fidelity.ca. Thank you so much for watching, and I'll see you next time on The Upside.